Okay, so even though the Dow closed at another record high, our next guest is warning that he's seeing some recession indicators flashing red. David Rosenberg runs Rosenberg Research. I want you to really dive deep into the specifics here, David, because as we said, PCE came in where it's expected. You've got unemployment holding steady at 4.3%. You have some earnings reports that have surprised to the upside, even if stock performance has failed to follow suit. So where are you seeing warnings?
Well, for one thing, you're talking about earnings for the last quarter, which is in the rearview mirror. It's interesting to me that you're seeing the stock market go up, and yet earnings estimates for the rest of the year have actually started to come down over the course of the past couple of months. And there's been no change from the analysts for 2025. So this has been purely multiple expansion related. And you mentioned the consumer, and yeah, the consumer is really exceeding expectations. There's no doubt about it. But we have this wide divide right now that's really incredible because real personal disposable income, after-tax income in real terms, is growing 1% over the past year, and your real consumer spending running almost 3% over the past year. So the fallout from that is we're seeing this relentless decline in the personal savings rate. I mean, this time last year, the savings rate was already pretty low at 4.5%. Today, it's 2.9. It's only been this low in the past 5% of the time. It's a 1 in 20 event. So I look at the consumer, I know what you're saying, but it's really the consumer spending report, I would say, is a low quality report because it's not being generated by real income growth. It's been generated by a continued drawdown of the savings rate to historically low levels. And when we talk about the recession, we've seen recession in real capital spending. The industrial sector is in recession, and the housing market has rolled back into recession. These aren't the biggest components of GDP. Of course, that's the consumer. But there are segments of the economy that are operating below the zero line. Admittedly, not the consumer ... Not yet. As for your comment on the unemployment rate, you know, it's not stable at all. It's gone up 80 basis points in the past year. And that's what's caught the eye of Jay Powell. That's the only reason why they're cutting interest rates is they're concerned now that there's too much slack being built up in the jobs market. So that's the story, is that you're not seeing job loss, but the unemployment rate is going up. And Powell's already told us that is the most important statistic for him right now.
So, David, do you think that the Fed is behind the curve on this, or do you think that this was unavoidable? Just a two-pronged answer. And do you think that the recession, whether we're in one now or there's one that's coming, do you think that it's a first quarter next year issue or a fourth quarter this year?
Well, it's a no-brainer that the Fed's behind the curve, and the yield curve. Speaking of curves, I've been telling you that for quite a while. But Jay Powell told us that both at the last press conference after the July meeting and then last week at Jackson Hole, when he's talking about how the economy is normalized. Inflation has normalized to a very large extent, and the labor market is not just normalized, but there's more slack in the labor market now than it was before COVID. So is he behind the curve? Well, you know, everything is normal except the Fed funds rate. And the Fed's own admission in terms of where its guesstimate of where neutral is 2.75%. That is the normal interest rate for a normalized economy. And the normalized economy is what the Fed's talking about. And they've got the funds rate at 5 3/8%. So recession or not, of course they're behind the curve.
Hey, David, it's Tim. Thanks for joining us. I guess I share that view, and I share your view, at least, that recession-proof, your term, sectors are places at least to be thinking about. It's fascinating that it's a year where you've had a bit of a barbell already. I mean, there certainly has been a very defensive play to the market if you look at what's been going on with gold, what's been going on with healthcare, certainly what's going on with utilities. How do you characterize what you do from here on out? Because based upon the moves we've had in some of those defensive spaces, that's telling you, it certainly is a read on some of the things you're thinking. Have we missed the move in some of these sectors that are not terribly cheap at this point?
Well, of course, what happens in those defensive sectors is that they get re-rated when investors start to see the economy cooling off. And the economy is cooling off. It's not in recession right now. And I think the consensus is that it's not going to go into recession. But, we have the supply side of the economy expanding over 4%, and GDP, which is what we all focus on, let's assume it's running at 2.5 to 3. That's what I'm talking about, is we're building up disinflationary slack in the economy. So I think what's happening here is that interest rates have been coming down. The Fed hasn't cut yet, but market rate, and they will continue to come down. So I would say that certainly the rate-sensitive sectors in this environment get re-rated with a higher multiple, and I expect that that's going to continue. What I call the bonds and drag, you mentioned utilities, which of course has defensive growth characteristics too. Bonds and drag in the stock market, so whether you're talking REITs or telecom services, utilities, yes, I think that they're very appropriate right now and being re-rated appropriately because of the interest rate outlook.